The Automatic Millionaire, complete one-part analysis. The central message of The Automatic Millionaire is that building wealth is less about earning an extraordinary income, possessing advanced investing knowledge, or maintaining perfect financial discipline, and more about creating an automatic system that consistently directs money toward wealth-building activities. David Bach argues that most people fail financially not because they lack intelligence, but because they rely too heavily on willpower. Traditional budgeting often breaks down because it requires constant decision-making, constant self-control, and continuous monitoring of every dollar spent. Human beings naturally experience decision fatigue, emotional spending, unexpected expenses, and changing priorities, making strict budgeting difficult to sustain over decades. Instead of depending on motivation, the book advocates automation. The goal is to build a financial system where saving, investing, debt repayment, and wealth creation happen automatically before money can be spent elsewhere. One of the book's most famous concepts is the latte factor. Despite its name, the latte factor is not specifically about coffee. It represents all the small recurring expenses that quietly consume wealth over long periods. These expenses might include daily coffee purchases, restaurant meals, subscription services, convenience spending, impulse purchases, and other routine costs that seem insignificant individually, but become substantial collectively. The deeper lesson is awareness. Small amounts of money invested consistently over long periods can potentially produce meaningful results because of compound growth. The book encourages people to identify recurring expenses that provide little lasting value and redirect those funds toward investments. The power comes not from deprivation, but from conscious allocation of resources toward long-term goals. The foundation of the entire system is the principle known as pay yourself first. Most people earn money, pay taxes, pay bills, spend what remains, and save whatever is left over. The problem is that little remains. Bach recommends reversing the process by saving and investing first, then living on what remains. In this model, wealth building becomes a mandatory expense rather than an optional activity. The principle can be implemented to automatic payroll deductions, retirement accounts, recurring investment transfers, and automated savings plans. A major focus of the book is using retirement accounts and tax-advantaged investment vehicles whenever available. Examples often include employer-sponsored retirement plans and individual retirement accounts. The emphasis is not on finding perfect investments, but on contributing consistently, taking advantage of employer matches when available, increasing contributions gradually, and allowing time and compounding to do most of the work. The philosophy is based on consistency rather than prediction. Instead of trying to outperform markets, investors focus on regular contributions over long periods. Another critical component of the system is the emergency fund, sometimes described as a financial safety net. Unexpected expenses are inevitable, whether they involve job loss, medical costs, vehicle repairs, home maintenance, or family emergencies. Without accessible savings, many people are forced to rely on credit cards or loans, creating additional financial stress. The book advocates building a dedicated emergency reserve through automatic transfers into a separate savings account. By automating the process, individuals gradually create protection against financial shocks without relying on memory or motivation. The emergency fund serves both practical and psychological purposes because it reduces anxiety and creates a sense of financial stability. The book also places strong emphasis on homeownership as a wealth-building tool. Bach argues that homeowners gradually build equity through mortgage payments, while renters generally do not accumulate ownership in the property they occupy. As mortgage balances decline and property values potentially increase over time, homeowners may build net worth through real estate ownership. The broader principle is asset accumulation. The book encourages acquiring assets that contribute to long-term wealth, rather than focusing exclusively on consumption. Closely related to this idea is the concept of accelerating mortgage repayment. Making additional principal payments or using payment structures that increase repayment frequency can reduce total interest costs and shorten loan duration. Because interest compounds over long periods, reducing principal faster can create meaningful savings over the life of a loan. The exact benefit depends on interest rates, loan balances, and payment schedules, but the underlying lesson is that small adjustments made consistently can create large long-term results. High-interest consumer debt is presented as one of the greatest obstacles to wealth creation. Credit card balances and other forms of expensive debt work against the power of compounding, because interest payments transfer money away from future wealth building. The book encourages individuals to prioritize debt reduction, pay more than minimum payments whenever possible, seek lower interest rates when appropriate, and avoid accumulating additional debt while working toward payoff goals. Automation plays an important role here as well. Automatic payments reduce the likelihood of missed payments, help maintain momentum, and remove the need for constant financial decision-making. The objective is to make debt reduction systematic rather than dependent on motivation. Beyond personal wealth accumulation, the book discusses the importance of generosity and giving. Bach argues that money should not exist solely for personal consumption or accumulation. Instead, financial success should create opportunities to contribute to causes, organizations, and communities that matter. The book encourages intentional giving and often recommends making charitable contributions automatic, just like saving and investing. This approach reflects the belief that wealth can be used as a tool for both personal security and positive impact. Ultimately, the book presents a complete automation model for personal finance. Income enters the system through employment or business activity. Before the money is available for spending, automatic contributions are directed toward retirement savings and long-term investments. Remaining funds enter a primary checking account. From there, automatic transfers move money into emergency savings, investment accounts, debt repayment plans, and other financial priorities. Bills are paid automatically whenever possible. The money left after these transfers becomes available for everyday spending. By arranging finances in this way, wealth building becomes the default outcome rather than a choice that must be made repeatedly. The most important lesson of the Automatic Millionaire is that financial success is largely a behavioral challenge. Many people understand the principles of saving, investing, and debt reduction. The real difficulty lies in consistently applying those principles over decades. Bach's solution is to eliminate as many decisions as possible. When saving, investing, debt repayment, and generosity are automated, financial progress can continue regardless of mood, memory, motivation, or short-term distractions. Over time, those small automatic actions accumulate, compound, and potentially create significant long-term wealth.